On today's Hot Sheet, we're talking about deal cancellations, rent prices, and loan lock rates. Today is Tuesday, October 24th, 2023. I am Byron Lazine, and the Hot Sheet starts now. After Alex Hermosi, which is devastating because everybody's going to be on an extreme high after him. And then I'm going to walk out. But Bobby's saying timeout. He just gave me the timeout. 1 second. 1 second. Bobby?
Hold on. Everybody in the chat, we're good? Let's get a thumbs up.
Bobby's asking for a thumbs up in the chat. Are we good, Bobby?
We should be good. Sorry about that, everybody.
All right, Hot Sheet's back. We're on hotel internet here at the beautiful Manchester Hyatt in San Diego. So apologize for that. Hit the thumbs up if we are back. And let's jump right into it. Obviously, we've got a bunch here to cover today. Redfin just released their market tracker, and they say that new listings and pending sales ticked up in September. We covered new listings yesterday. Really just following the seasonal normality on new listings. We're at all-time low on new listing data. But what's interesting here from Redfin's report is what they're talking about with home purchases falling through at the highest rate in nearly a year. You can see here on the chart below, which will be available for all BAMX members in our daily download in BAMX. You can use code HOT to get access to BAMX. You can see here that we are now at 16.3% for monthly pending home sales that fell out of contract as a percentage of overall pending home sales. A year ago, when we had the initial rate shock of breaking 7% on the 30-year fix, we were at 16.6%. So if this trend continues, this upward trend of deals falling out of contract, we will be at over that 16.6% on deals falling through. Obviously, during the COVID pandemic, that number was even higher. But these are shocking, volatile times. Rate shock of over 7%, up over 16.6. Rate shock now accelerating past 8. 10-year breaks 5 for the first time since 2007. Boom, we're now breaking 16.3% once again, and COVID. But everything else on this chart here was really riding around 12%. 10 to 12% is much more normal, but buyers are extremely cautious. So if they get into an inspection or a negotiation, a renegotiation that isn't going in their favor, they're more likely to back out than they were just a couple of years ago when there was a scarcity factor, when it's like, well, if I back out of this, they're not negotiating because somebody's just going to step into my place. It's less likely that somebody will just step into their place. Prices, of course, according to Redfin, continue to climb as a lack of supply creates competition. The U.S. median sale price rose 1.9% year over year to $412,081 in September and fell 2% from a month earlier. It's typical for this time of year. Activity in the housing market, Redfin says, is sluggish due to these rates. Prices remain near their record high because buyers who are out there are competing for this limited number of homes. Nearly 2 out of every 5 homes, 37.4% that went under contract in September, did so within 2 weeks. That's up from 32.6% a year earlier. So it's showing you that there are still, for this limited inventory, a significant amount of competition in the market. Let's take just a quick look at some of The overall stats here for September in the U.S. with Redfin. Again, we've got the median sale price there at the top. Pending home sales are up 1.3%. Homes sold, according to Redfin, month over month are down 1.5%. Year over year, those are both down over 12%. New listings down 8.9% year over year, but they have us up 1.4% month over month. All homes for sale, all inventory. So they go with more of an NAR number. They have us at 1.347 million. Obviously, I go with the Altos research number, which has us in the 400,000s, because I want to know what's active on the market, not what's pending. So Redfin's number, I don't love that number. If it's pending, to me, it's really off the market. You're not able to see it as a buyer. Okay. Months of supply, 2.5 according to Redfin. That's way lower than what NAR is reporting in the mid threes for months of supply. Median days on market, according to Redfin, is at 33. And then share of homes, for sale homes with a price drop, they have 18.8%. That number, according to Altos, according to Fannie Mae, is much, much higher. So Redfin coming in with numbers that are much different than other sources here, which is good to know, because if, consumer says, seller says to you, well, Redfin, because they're looking at Redfin, right? A consumer looks at Redfin, they look at Zillow, they look at Realtor.com. And so if a consumer says to you, well, Redfin says only, 20% of homes are dropping their price. Well, Fannie Mae says it's over 40%. And Altos Research has it at 38.5%. So not sure the disparity there on Redfin, but these are two other ways to look at it. And here in our market, on our MLS, it's actually X amount, right? So this is what's going on nationally. There's contradicting reports here, and then here's what's going on deep in our MLS. Share of homes sold above the final list price, according to Redfin, 33.5%. Average sale to final list price ratio, 99.6%. And again, 16.3% pending sales that fell out of contract. Love to know in your market, are you seeing that rise? I'm certainly seeing that in most markets where you do see sales falling out of contract, rising. Maybe they didn't lock into the rate. Maybe it's like, hey, I'm already feel like I'm overpaying, and now I'm not getting what I want. What I want out of this real estate market, and what I hope that you want, is for these rent prices to continue to come down. And according to our good friend over at Realtor.com, Daniel Hale, who we'll have on at Knowledge Brokers Podcast on Friday, that's just what rent prices are doing. September 2023 rental report from Realtor.com. Rent prices fall for the 5th consecutive month amid strong demand for affordable units. Why do we want rent prices to come down? Because inflation comes down. Shelter makes up over a third of CPI report. And the quicker we can get the Fed to realize that rent prices have not only come down in September, but they've been coming down all year, the sooner we can get a real number on inflation. Remember, we bring up that Wall Street Journal article all the time. If we tracked inflation how they do in other countries, we'd already be near our 2% inflation target. That's if we take out that imaginary number, that survey that we do in this country, asking homeowners what they believe their house would rent at. These are people that aren't even in the rental business. This isn't apartments.com or rent.com. This isn't CoStar that they're asking. This isn't real-time data that's available at our fingertips, like the data that Realtor.com is sharing with us. This is a survey. This is a make-believe imaginary number. That's Wall Street Journal's words, not mine. So in September, we marked the 5th month in a row of year-over-year rent decline for 0 to 2 bedroom properties. It's 0.7% down year over year. The median asking rent in the 50 largest metros dropped to $1,700 and 47. So $1,747. It's down $5 from last month and down $29 from the peak 12 months ago. Every dollar counts. I think this trend continues as we see all this inventory come online in the multifamily sector. Median rent decline for all size categories. Studio is at just under $1,450, down 0.5%. year over year. One bedroom is at 1630, down 0.3%. Year over year. A two bedroom is at 1934, down 0.7% year over year. While the annual rate of multifamily home construction ticked up in September, the faster absorption rate of completion units compared to pre-pandemic years suggests that strong demand is still in the rental market. I think there's going to be demand there, but we have so much new inventory coming on. Why do I think there's going to be demand? Obviously, because we are in the most unaffordable housing market we've seen here with what it costs to actually buy a home. If you missed yesterday's hot sheet, we shared that graph. It's in BAMX for BAMX members, that when rates went from 7 to 8%, 5 million potential home buyers were priced out of the market. That's how unaffordable it is. You can see the rent decline here, not only again, but consistently throughout the year when you look at median rent year over year. Okay, median rent, obviously, the red line has increased dramatically the last couple of years from about $1,400 in 2021 to now $1,750, but the percentage year over year has dropped significantly. Obviously, 16% on rent prices was not sustainable. I know a lot of investors, or investor bros, if you want to go that far, just want to believe that rent is going to accelerate at double digits every single year. Not sustainable with the amount of inventory we have. And this is the reality. If you're an investor yourself, or if you are advising an investor, I expect this trend to continue over the next 12 months as all of this multifamily inventory comes online, certainly in specific markets. Of course, rent in the long term is going to continue to go up. And you will have strong demand for sure. If the market here, the housing market continues to be this unaffordable, you might have your biggest wave of renters in 2024 and into 2025 you've just ever seen, just based on how unaffordable it is to purchase a home. September rents here in the graph, looking at studio, one bedroom, two bedroom, that'll be available for BAMX members, of course. All right. And now if we just look at affordable new rentals and how fast they're being absorbed, of course, they're being absorbed extremely fast. Affordable homes and affordable rentals are very desirable right now. So if we look at percent absorbed within 3 months after completions, anything less than $850 is being absorbed 75%. Anything less from $850 to $1,050 is being absorbed up over 90%. $1,050 to $1,250 absorbed over 75%. And then you can see the drop off once you get from $1,250 and up, moving towards the right. So affordable new rentals are certainly being absorbed faster here in quarter two, according to Realtor.com, of 2023. Makes complete sense, of course. Despite record construction, Realtor.com says that absorption is up in all 4 regions. Okay, interesting. You've got Northeast, average completions is in the red, and then completions for quarter one in the gray. Same thing here for the Midwest, South, and West. And in every market, they're showing that absorption is up in all 4 regions. But most of this new inventory is coming online here at the end of this quarter and the beginning of 2024. So we'll see what that does as we go into the end of this year. We'll see if we're going to see vacancies start to increase in some of these areas. Let's take a look at some of your major metros. We've got Austin, Texas down 7.3% year over year on 2-bedroom, 0 to 2-bedroom apartments. This is a precursor for many markets that overbuilt on multifamily. Be thinking Nashville, be thinking Tampa on this Austin, Texas number. Atlanta's down 4.9% already. Boston, while Boston is at $3,043 for a median rent, they're up 4%. Okay. Charlotte's down 2.2%. Affordable rent there at $1,600. Chicago down 0.6%, $1,800 in Chicago. Dallas, Fort Worth. Here's another precursor of what's coming in many markets across America for apartments, down 6.2% to $1,530. Denver's down 1%. Las Vegas is down 3.3%. LA, just north of where I'm sitting, is down 3.4%. New York is up 4.5%, $2,800. I don't know, Manhattan, $2,800 might not get you too far. They've got Jersey City and Newark mixed in there to kind of bring that number down. Orlando's down 5.4%. There was a huge over compensation in Orlando of Airbnb investors and just investors in general. So Orlando down 5.4% to 1710, Portland down 5.4%, Phoenix down 5.2%, Raleigh down 4.3%, Sacramento down 3.3%, San Francisco down 4.8%, San Diego, where I sit here today, down 2%, San Antonio down 2.4%, Seattle down 3.9%, Tampa down 3.9%. Some of these numbers are going to get bigger over the next 12 months on rent prices. That's my belief. That's what the tea leaves are showing us. And before they start, of course, over the long run, going back up. But it might provide an opportunity in 2024 for you to invest in real estate and get a deal as rent prices go down.
Dawn from East Texas saying she is seeing the same things in her suburbs.
Dawn is seeing the same things in the suburbs. And so that I think a lot of people bought suburb homes thinking these rent prices are just going to go up. Everybody wants to go to the suburbs. Things are changing. Things are shifting out there for sure. Just an update from John Burns that I thought was particularly interesting. Alex Thomas from John Burns Consulting on Twitter X tweeted out this chart. We'll put it into BAMX, of course, daily download for BAMX members. 10% of all mortgage locks in the past week were locked in at rates below 6.5%. Buyers would love to hear that. The only way to get that, though, is to work with a builder. This is entirely due to builders offering rate buy downs. New homes now represent 13% of all home sales nationwide. This is a level we haven't seen since the early 2000s, according to John Burns Consulting here. You can see 4.5% to 5% was 2.2% of loans. 5 to 5.5% were 1.1% of loans. 5.5% to 6% were 4.9%. And then 3.1% of loans were from 6 to 6.5%. 50% of loans were 7.5% or higher. Some folks, 25% almost, got in at 7 to 7.5%. And then 6.5 to 7 was at 9.4%. So still opportunities here to get under the median or overall median mortgage rate. We've been hovering up around 8, although yesterday we did tick down, thankfully, under 8% on the 30-year fix. Yesterday, we ended the day at 7.91, according to Mortgage News Daily's 30-year fix daily survey. Hopefully that holds today. Love to just keep that away from the number. The 10-year ticked down a little bit at the end of the day, which was why the 30-year came down for us. We're at 4.863 right now, just ticking up a little bit here this morning. We'll continue to monitor that, of course, see where the 30-year fix goes later today. The Dow, S&P, and NASDAQ are all up here to start the day on this Tuesday. That's your hot sheet. If you want to get the most out of everything we do at BAM, hit the link down below to sign up for BAMX. Use code HOT, of course, to get 10% off the annual. And love to see you guys in our private Facebook group. And you get access to all of our courses, extra content, and our daily downloads that we do every day here on the Hot Sheet. Thank you guys. Subscribe, hit the bell. We'll see you back here tomorrow on the Hot Sheet. Later today, I'm about to do a real word. We've got the real word at 2 o'clock with myself and Nicole White here on the channel. So make sure you're subscribed for that. And again, we'll see you later on. Till then, toodaloo.